Risk acceptance.
When a firm has the luxury of having a certain amount of slack available, it may be more willing to take calculated risks. For example, a firm with a very successful, revenue-producing product line might be more willing to take some risks on a new, risky project than a firm that doesn't have a guaranteed income from a successful product to fall back on. In other words, if a firm knows that it could absorb losses without those affecting the business in the long term, it might change the firm's willingness to take risks on new products. Real options are also assets, similar to the successful product, and as such having options and knowing how to efficiently create and use options may change the firm's willingness to take risks on other, more risky options. For example, if a firm already owns several high-producing oil fields, it may change its consideration of a new project with a higher than usual risk. In other words, the ability and knowledge that the firm knows how to efficiently use real options may have altered its risk aversion, and the combination of the current assets of the firm and the firm's confidence in its own ability to manage real options may alter the firm's risk tolerance. The firm may feel like that it can take some chances because it has a certain amount of slack resources, for example, cash from the revenue-producing asset, etc., that will help absorb a negative shock if the new venture doesn't work out. Conversely, firms that are less confident about their ability to follow a real options-based strategy may be less likely to take risks on projects that would require the efficient application of real options. In an extreme example, this might lead to the already successful firm taking more risks, and the less successful firm taking fewer risks. This in turn may increase the already existing variance in performance between the two companies,